and welcome to Serenity Now, a place for entrepreneurs to ask questions, learn, get connected, and be inspired. Join us as we talk about all things business and the search for the ever-elusive Serenity Now in both business and personal life.
Arthur, why do we want to listen to this episode today?
Because you want to be able to leave your business on your own best terms.
Welcome, everyone, to another episode of Serenity Now for entrepreneurs. We've got an exciting, I think, episode today, and we're diving deep into the whole mystery surrounding how to sell a business. And perhaps this time we'll be able to share some insights or some strategies to help you do it maybe a little more successfully. So let's kick it off. I have today with me my fellow Serenity sister, Candace Nanka. Hey, Candace.
Hi, Rita. Hello.
And we've got our extra special guest, our partner, our colleague, Arthur Klein. Welcome.
Good morning. Good morning, Rita. Good morning, Candace. Good to see you both, and thanks for inviting me on your session today.
We've all been around, I think, at least 20 plus years in industry, and we've known each other for at least a decade. We were chatting before we started. I think it's been at least a decade, right, guys? So if we're going to talk about something as important as this, we wanted to make sure there was a great deal of trust and a great deal of respect. And that really does fall upon each of the folks here today. And we've all had the opportunity to work together and support our clients together over the years. Before we dive in, I thought it would be important for everyone to understand who's Arthur, in case you don't know him already. And why is Arthur here on this very special hot topic? Arthur, I thought I'd get you to take the stage, introduce yourself, and go for it.
Great. Okay. Thank you again to you both, Rita, Candace. Yeah, my name is Arthur Klein. I'm a mergers and acquisition advisor with Smythe LLP here in Vancouver, BC. We're a mid-sized BC-based accounting firm, 3 offices in Nanaimo, Vancouver, and Langley. I work specifically within our advisory group, where we focus on professional valuations for a variety of matters, whether it's reorgs, tax matters, family law matters, and so forth. And then myself, I focus specifically on working with private business owners, lower mid-cap business owners on the market assessment of value of their companies and the confidential sale of their businesses, typically to strategic and or financial buyers.
Wow.
Great.
Let's unpack that.
So I think selling a business, to say the least, is a very complex and also really important to share emotional journey. There's going to be lots of ups and downs. And because we've been through so many of them together and with lots of our clients, we just wanted to give you some considerations for sellers and how to explore perhaps how sometimes things can go off course. Before we do the off course stuff, though, I wanted to try to do some inspiration because people get, you start going to this negative Nelly stuff, right? So I was kind of searching for some quotes, of course, and so I saw this one. I thought this would make a lot of sense and it would resonate really well. So success is not final. Failure is not fatal. It is the courage to continue that counts. Winston Churchill. And then now let's just dig in. Arthur, I'm going to give you a loaded question, and then Candace can probably jump in after that and interrogate you further. But overarching, if I'm listening to this, what are the perhaps top 5 things that I'd want to consider? And you can start with the top 5 and then we'll unpack them as we continue through the session.
Kind of borrowing on Churchill, it's a journey, and what he's talking about is, what he's really referring to is it's a life journey. You have successes and you have failures, and he was all about perseverance. And probably the biggest thing that a business owner can do in that consideration of business sale is, can they answer to themselves? Can they say to themselves, I've accomplished what I set out to in my life, in my career, in my business, professionally. It's a hard question for a lot of business owners to answer because materially, like us, we're business professionals. We show up with an identity. We have our titles and so forth. And, that's we reflect ourselves or demonstrate ourselves in our professions and as being subject matter experts. And the same with the business owners. They are subject matter experts in their business. But at a certain point, the vernacular I use, at a certain point, we have a best before date. We have to be rational relative to not just in terms of where we are, in terms of retirement planning and so forth, but personally, can I see myself doing something else that I've always been doing for the last 10 or 15, 20 years? And if business owners can get to that point and really saying, yeah, you know what, there's other things that I want to accomplish that doesn't include this business, that's an exceptional first step. And like all of us, it takes a village, and it's not a question that always can be answered, by looking yourself in the mirror. It's a question that you should be talking to your spouse or significant other. You should be talking to your family. You should be talking to your strategic influencers, whether it's your financial planner or your accountant, your best friend, and say, okay, what do I do next? I'm at this point. What do I do next? Or I'm at this point. I need to figure a way out. How do I get there? And being vulnerable to, making that change is huge.
I would argue that you probably need to start making those plans when you start thinking you might be there in the next 3 to 5 years, because in my experience, getting ready to sell is not a 2-month ordeal in most cases. So do you have any comments to make about that?
I've seen business owners kicking and screaming, I can't see myself leaving, or they have this attitude that no one else can run their business. And that's a fatal flaw. I hate saying it that way, but it's a fatal flaw to think that way, because you never will leave your business if you have that mindset. To your point, Candace, absolutely. Owners should be thinking 2 to 3 years ahead of a defined timeline. And in many cases, it has implications. There's implications.
What you can do to get ready with accounting wise.
I guess the accounting and the financial, there are accounting factors and financial factors that are often at play that necessitate an owner being proactive at least 2 to 3 years in advance of their exit from a point of view of selling their company. One core accounting piece is, as many private business owners across Canada certainly try to realize and support, is will they benefit from the lifetime capital gains exemption qualifying small business corporation? And that has many different facets to it that I know that you can speak to more specifically, but materially, if the company is not properly set up legally and relative to certain accounting tests, there's effectively a 2-year reporting period reset to allow that company then to meet the guidelines to qualify for capital gains exemption, at which point then the owner is in a better financial position to exit, protecting hard-earned capital on the sale of the business. So there's that, and again, I know you can speak to more details on that. The other side of the equation, which is significant, that relates not only in terms of what their tax position is, where's their value position? And I've been doing mergers and acquisitions for 14, 15 years. And I don't keep track anymore, I've done countless number of business assessments of value. And easily 50% of the time that I'm presenting that number, it's way below where the owner expects the value of their company to be today. And that's a huge problem because, again, for a lot of business owners, the business is a significant portion of their retirement planning portfolio and mandate. Again, part of that conversation that I talked about before is, can they comfortably retire based on what they own within their investment portfolio, let alone can they retire based on what they expect to realize out of the sale of their company?
I'm just going to interrupt you there because I see Rita biting at the chomp to ask a question.
We always like to clarify points that might be familiar to us, but may not necessarily translate to something easily understood to someone that might be new at listening to this. So you mentioned something called the capital gains exemption. I think that we should just take a step back and talk just a little bit about that, but I'm going to throw it to the corner of our awesome expert, Candace, and maybe you can explain, what does that mean with all the disclaimers you need to help people understand. Why is Arthur talking about that? And what does this 2-year thing mean? I have to wait 2 years before I sell my business. Just want to clarify that piece.
I'm going to try and do this as simple as possible with as few accounting jargon as possible. So basically, in the Canadian tax system, there are a set of rules, when they're followed properly, that you can sell an incorporated company, you can sell the shares of an incorporated company to somebody else that's not related to you. And the first 900, I think right now it's about 900,000 of it. Is it up to 1 million now? It's indexed, so I don't keep up with the number. So the first 1 million of it can be tax-free. However, the rules are complex. There's this 2-year reset that Arthur has mentioned. And also before that, if your company's not already set up to be sold that way, it might take another 3 or 4 or 5, 6 months, depending on the complexity of your business, to rearrange it so that you can start that 2-year window. So it takes significant time and planning. It can be of great value, but there's also other ways to, depending on the business, there's other ways that you can take advantage of tax rules to sell. So it's not the end all and be all, but it is an important consideration for sure.
Perfect. I think that helps with a little bit of understanding. And again, if you want to learn a little bit more, hey, great. Reach out to Candace, reach out to Arthur or myself. We're all happy to add support. I'm going to position you to speak a little bit more closely with Candace and Arthur on this, though. So, with always the ongoing changes. Okay, so then Arthur, you had mentioned valuation. So this is a big, big topic that, we could probably take 5 episodes on, but we're trying to bring it down to some manageable pieces here. And I really like how you gave an overarching understanding. And one of the things that's important is if you've done this for so long, and so have I now, and so has Candace now, and you said about 50% of people think it's worth more. I would lean to probably even more. But at least that's a good baseline to say, okay, you likely don't have the right valuation. And that's why, again, it's another reason, for it to be important for once you have that understanding that I think that there are other things that I'd like to do other than just this business, and then start talking to, some friends and do some considerations as you speak to your advisors and your team that you're going to be building around you throughout the next couple of years for this process. Yeah, then that's the time you start looking at something like that. And then, of course, the next consideration would be like, how do you look at the valuation and why is it always, what are the top reasons why they're kind of so far off? Or how do we help improve this number?
One scenario is that the owner thinks, well, I know if it was someone else and if they made all these changes, they can realize that performance that's, significantly higher than what they're realizing today. And obviously I say, well, that's someone else's time and investment. It's their value. It's not your value. And you have to pull it back. Like you say, great, I'm glad you're looking through rose-colored glasses, but guess what? It's you. We're valuing you and your ownership and management of the company and what you are doing to make it profitable, that you are doing to mitigate income risk, that you are doing to grow the company, that you are doing to reduce owner dependency and so forth. And actually, what I just said there, those 4 things, those are the 4 key value drivers that we contemplate within our pricing, what we refer to as our pricing analysis. So what's the profitability of the company? How is the company able to manage against any income risks? How are they growing the company? And how are they being able to diversify to make you, the owner, redundant? In terms of, I'm working with a client right now where income risk is a great factor and, things that companies don't always think about. They think, great, I've been doing this all along, whether I'm a manufacturer, or whether I'm a distributor or a business services company. And probably the biggest thing that catches people off guard is even though they've been successful, even though they make money every year and so forth, they overlook the fact that they often have significant income risk. And the income risk typically is tied to 2 things. They are over-concentrated in terms of customers, or they're over-concentrated in terms of suppliers. And if any one of those 2, if you have a 3-legged stool and you, the owner, are the 3rd leg, if any of those other legs fall off, guess what? The rest of the stool is going to fall over. And materially, we are, and the market is going to significantly discount the value of the company if there's significant risk or concentration risk. Concentration risk, again, in terms of customers, and concentration risk in terms of suppliers. If there's risk, because many businesses don't operate with management agreements in place. They are handshakes. They're business relationships that have been supported and nurtured over the years, but it's still just a relationship. And there's nothing on paper to say, will it transfer? Is there an assurance that is going to continue to transfer on an ongoing basis? I always, in talking to a business owner, put yourself in that buyer's shoes. What kind of questions are you going to be asking of yourself if you were trying to invest in me and, or invest in yourself. And it's not always an easy conversation for an owner to think about.
No, I'm with you on that. It's definitely not. And I've seen this so many times, Arthur, and the way you kind of laid it out was very gentle, as opposed to some. Candace is having a good laugh on that. And so it is quite gentle. We kind of flip it around with risk mitigation. And this is what you're trying to do too, is help them see it. Look, we see a concentration. So how do we work on mitigating that risk? Well, let's diversify our suppliers. Let's diversify the customer base. And then that will start to build those pieces out for your risk mitigation strategies. And, one of the things that I talk about a lot is if you just consider the pandemic, and if we were all with one supplier to, for example, get stuff on a boat to bring it over, we know what happened with that boat back, in 2020. And I was working with one of the largest managers of freight. And he was like, basically, things are getting bumped off. They're just like not even able to get on. The cost of a crate was $5,000 before, and now it's $25,000. If you didn't have a backup supplier in some of these areas, you were just not able to run your business if you were relying on some raw materials or ingredients or something. So I think that some of the business owners have the backups, but they probably have it in their head. And this is part of building your process and rebuilding those relationships to start saying, hey, let's get something in place. Let's start working on this. And we found it happening quite a bit in the last couple of years. So suppliers of finance is also really important as well, because as you move forward, some of these suppliers of finance are also willing to support the buyer as they want to do some consideration. So you're actually doing everything that you can to actually help yourself run your business and continue to grow it successfully. But you're in turn, what I find, like we use the word turnkey, trying to get to that turnkey position of someone else buying the business. And turnkey, what that means, because I know that one of you will bug me now. What does that mean? It basically means, Arthur, you and I are doing a handshake. And of course, we did all our due diligence, and Candace and Smythe, everybody was involved. Don't worry about that. And we agreed, I'm taking over Arthur's business. And I basically can walk in the next day and turn the key, open the door, and start working. And so in order for that to happen, we had to have a lot of things in place, like SOPs and the things that we'll be discussing throughout the session. So fantastic. Thanks, Arthur.
Why don't we move on to SOPs, actually, standard operating, because this is the key to getting the owner out of the business is having those in place. Who wants to jump onto that meaty topic?
What I'll respond to that, Candace, is that whether your business is doing $1 million in revenue a year, or $40 or $50 million of business a year, chances are, as an owner, you have a significant footprint on the company, and you may have good people, around you, but it's probably just human nature that, as I said before, no one can do it better than me because I'm the one that started this company, or I'm the one that built it up from over this timeline and so forth. So really, in terms of standard operating procedure, is significantly and proactively finding ways to make you as an owner redundant, finding the right people, and let alone finding the right people that you can develop. They may not necessarily always be available, quote unquote, off the shelf, but you may find the people that have the background and experience that you can nurture and develop over time to take on the active roles and responsibilities that typically fall to a business owner. And that's huge for two reasons. One, obviously, it has an implication relative to profitability and income risks, as we talked about before with supplier and customer concentration, because if there's owner concentration or a significant amount of personal goodwill, that's going to reduce the effective value of the company. Look at it from the point of view, if I'm the buyer, and look at it from the point of view of, as Rita said, I want something that's turnkey. Well, guess what? A lot of buyers right now are not necessarily buying the company because you have this product and you make this much money. They're buying the company because you have people that can perform at a certain level, and those people represent an opportunity to grow into the future. A lot of buyers are not necessarily buying the company just for that bottom line. They're buying it for the resource that your company has created over time, and hopefully through the direction of that ownership and creating the procedures in order to build and train and grow key employees to allow the company to operate without the owner being present.
It's harder than it sounds too.
Yeah, we've gone through this so many times, and so I think sometimes Candace, Arthur, and I are pausing. You might be hearing us pause because we're trying not to verbally hurl everything that's in our heads. I guess that's the easiest way to put it. But as you're talking through, SOPs or standard operating procedures, or, these are things like I remember 10 years ago when I started talking to some of the owners, like, don't worry, we know how to do that. Don't worry, they'll figure it out. Don't worry, I can share. I'm like, okay, it's awesome because it's in your head. If you talk to farmers, they're notorious. Yeah, I know how to do that. Why? Come on. This is pretty straightforward. So trying to pull it out of their head and perhaps looking to an external advisor to help you with that makes a huge difference, because sometimes there's just a block in trying to put those down or start working on those. And so that will help. I also find some top people in the team. You never know. You find your champion or your ambassador. And there are people like that. And they love putting these things together. In our firm, in each division we have basically, I started the template for each role. For example, research analyst, and then everybody had to do something or add something unique to it every single year. So that's an innovation, something outside the box to make it more efficient or stronger or better. And it's always being updated, but I don't have to update it anymore. I just look at it and go, oh, hey, that's great. Okay, here's a bonus because you did a great job in making it easier for us, easier for the client, and overarching for the company. So it's sometimes it's hard to look at the whole thing in one shot, but if you start with just a piece of it, you can begin the process. And again, give yourself the time and the opportunity to do that.
Yeah, and I was, it's going to echo back again that quite often where owners don't feel that they have the time because they're taking on all those responsibilities themselves, and to start to let go of those responsibilities, to put your first like your first in-line manager, your second in-line manager, and so forth. One step at a time. If you start building that management capacity, it makes those it allows that time to come back to the owner to put those other procedures in place that effectively should help you grow, manage, and drive the value.
So I think you were talking about managing your income risk. You were talking about diversifying your base for customers or suppliers. And then you also, I think, mentioned something about profitability. That's also something that you need to consider. So Arthur, why don't you chat a little bit about that?
Yeah, profitability honestly is, why are we in business? Why are, again, whether you're manufacturing, distribution, managed services, food production, whatever, why are we in business? We're in business to make money. And ultimately you want to be able to know that profit, the ability of the business to generate profits has, buckets. It's coming back to me. It's coming back to the family. It's coming back to the shareholder. So we know that there's responsibility to the ownership of the company. Is there the profitability that's going to service any debt that the company is carrying, whether again it's personal debt or whether it's bank debt or have you? Does the business need to reinvest in itself? Some businesses have significant asset requirements and asset reinvestment requirements or capital capex expenditures, and that has to be accounted for in terms of the profitability of the company. And then and the other layer is, okay, how are you going to grow, and where are you going to invest in the profits of the company to allow your business to grow, to put in the necessary tools that you haven't been able to do to manage your business better. Perhaps it's even thinking about an exit, but you're actually wanting to grow your company through an acquisition in order to position yourself at a higher value in order to exit again at a much more dynamic level. So there's many different levels in terms of what is that profitability for, but ultimately it looks from the point of view of you need to have that capacity in order to drive the business forward and provide effective returns for yourself.
Right. So that couple of things came to mind as you said that is making sure you keep the foot on the pedal. And the other part, the simple question that a lot of people ask is, but Arthur, I am profitable. I just can't show you all of it because if I showed it all, then I have to pay too much tax, because you've never heard that before. So
which kind of dovetails nicely into maybe Arthur's article about accounting records, make or break the deal.
We're teasing Arthur because he's in the midst of writing an article, how accounting can kill a deal. It's not finished at this moment of recording, and we're teasing him saying it will be finished. And so we're just lighting that fire there for him. And we can't wait to read the article as well.
Yeah. Thanks for pushing that out there, ladies. I appreciate that. The first thing I'll say, and I know, Candace, as a longstanding accounting professional, will always say invest in taxes, because you may feel that your business owes you something that the government shouldn't have. Well, at the end of the day, if you want to be able to sell your company in straightforward, clean, clear manner, you need to be able to prove that the performance is on the books. And the vernacular I use, if your fingerprints are littered across your financial statements, guess what? The buyer's going to be dusting them off and cuffing you for lack of clear accounting. Simple as that.
It's as simple as that. And there goes the value that you thought you had as well on the finance side of it. So let's say a buyer is looking to pick this business up. If you can't see this profitability, it's going to be really tough to say this company has a cash flow to service the debt that you wanted to get to finance the acquisition of the business. So it just continues in a circle. But if you're worried about tax, again, talk to the expert. There's tax strategies, and just like, the idea of no tax strategy when people talk to me about, well, how do I bring this down to zero? That's not a strategy. To me, that's another episode, not a strategy.
To me, tax is an excellent problem to have.
And that comes from the lips of the accountant. There you go.
And maybe it's more of an indication of that, okay, now you have to worry about what's your structure. How do you hold the company legally and otherwise, and investing in your tax planning in order to realize the best return when you're at that exit.
Yeah, and just to be clear, I'm not saying that you should pay 1 cent more than you have to, but I'm not for that. But paying tax means you're profitable, so fair amount of tax.
Yeah. Arthur, you mentioned something just briefly in the last comment about structure. And I think that would be important to kind of walk through as well. So let's say I've got a company and I started the company and I was manufacturing widgets because that's the easiest one that we can always talk about. And then I grew the company, but then I said, you know what, the building that I'm in is perfect for the continued growth. And I purchased the building, but it was all still in the main company. And then I decided to acquire another business. And then, that came into the same company. And now I'm ready to sell my business. Perhaps you could help with some thoughts on some of the potential concerns you see there and some, potential ways to consider how we can look to mitigate some of those risks.
Back to your comment about the article that I'm writing is the topic is how accounting can affect or kill a deal. And one of the things that definitely can affect an ultimate transaction or ultimate sale of your company is, does that operating company hold or own the real estate within that operating company? And the reason why it can affect the deal is, I'm going to use the 50% kind of metric, and it's more arbitrary than anything, but 50% of the time, the buyer, who's often, again, a strategic buyer or financial buyer, they don't need the real estate. They don't want the real estate, or they don't want to be in a position where they have to leverage additional financial instruments in order to carry that real estate, because they are in the business of making widgets. They're not in the business of real estate. And when you try to separate, so if you have a buyer that is ultimately going to come across that company that you're referring to, Rita. If you have a buyer says, well, great, I like all of this that you've created. I like the widgets that you make. I like the people that you have there that are present in order to run the business forward, but I don't need the property. And now, and I'm going to go back to Candace, I said, now you have a tax issue because you have to decide how do you separate those two and what are the implications, not only to capital gains exemption in terms of how it gets separated, but there's also, tax consideration in terms of, capital gains on the real property, let alone property transfer tax if you're here in BC. So a lot of tax planning has to go into that, but also it should be contemplated from the point of view of how are you going to make yourself sellable? Put yourself in this shoe. How do I make myself in the best position to the broadest market? Because the more eyeballs, ultimately our job in mergers and acquisition at Smythe is we want to qualify the business such that a potential buyer can clearly and consistently understand what is the investment opportunity. Will it manifest itself later on?
I think he was throwing it back at you, Candace.
I love how you.
Yeah. Well, it is. It's, and that's why it takes a village. Rita, you mentioned it before, we're not doing it in isolation of the lawyer. We're not doing it in isolation of the accountant, in isolation of the ownership, isolation of the financial planner. There are many external advisors that a business owner should be talking to relative to this whole planning exercise.
Honestly, I think even if they're not ready yet, but they think they're going to be ready at some point down the future, that's the time. Get your team together, get your accountant, get your mergers, acquisitions person, get your finance person, get everybody in the same room and have a conversation and figure out what the path forward is, because it's going to be work to get the best dollar, I think.
Yeah. It breaks my heart when I've seen so many times that we've all seen so many times. We know there could have been such a stronger, position for the seller, and they put 30 plus years, everything in there. They sacrificed a lot to get to where they were at. And it just hurts to see them not being able to get the most of it back out. And I think that's why we kind of all do what we do. We've either gone through it or just seen it too many times, so that we're trying to get this out there to help with the process. I mean, I think we could talk for a very long time on this, and just so you all know, we do with each other. But if there are any kind of questions that you have, I hope that you may now feel a little comfortable perhaps reaching out to Arthur or Candace or myself. But if it's specifically on considering selling the business, Arthur is the guy. Just give him a buzz and shoot him an email. He's not that scary. He's not that scary. So
we earn our filters in life, right? Yes. Yes. Every conversation is confidential because, again, we recognize, there's significant factors to that. Thank you. I'm happy to have that conversation in confidence. Very personal consideration.
Yeah. So I think this is the kind of time that we go around the room. Arthur, I think you've heard this before, and we just share either a last insight or somebody might have a last question to one of the other folks in the podcast, or just something that we thought was really insightful that we wanted to share. And I think I'll start with Candace. Is there anything, one final thought or thing you wanted to share?
Yeah, I was just going to say that I like all the stuff that we've touched on today, because I feel like even though we haven't gone in depth, but that's not the point of the podcast, but we've touched on the major things that you need to really think about when you're selling your business. And if I'm just going to stress it again, I know I've said it twice or at least already, start early. Even when you think you might be going that way, start early, because it's never too early to start.
I agree. Arthur, please go ahead. You're up next.
And just to dovetail on Candace's point, I ideally am talking to a business owner 2-3 years in advance, ideally 3 to 5 years in advance, because there are many different facets associated to selling the company. It's not just when, and it's not just how much. It's not much, it's where. There's so many different facets to what's involved in there, and in certain cases, it's going to take a fair bit of runway being time, in order to get to your best position, your best goals, and don't leave it to the last minute, and do not feel bad that you have to ask the question or stop. Feel embarrassed that you're asking a question, because no question is a bad question. And just be open and honest. Where you are at is huge, because I've worked with a lot of great clients, but I also worked in a lot of cases where things could have been a lot better if. But unfortunately, circumstances didn't result in that case.
Yeah, no, I'm going to continue with that thought process. When we start with clients, we always start with the end in mind, and we start posing those questions immediately and start working on building a team around that, even though they're kind of like, what are you doing? Well, that's part of risk mitigation and growth, and, bringing in new team members and all the strategies that come along with it. So I think it's really important, as we've all alluded to throughout the conversation. Time sometimes is on your side. And if it's not, make it, bring it to your side. And that allows you to maximize your value. So I guess at the end of the day, we hope, thank you for joining us today on behalf of Serenity Now for Entrepreneurs, and Arthur, Candace, and our friends at Smythe LLP, and myself, Rita. We hope that today's episode has provided our listeners with, a deeper understanding of some of the critical issues that we uncover on a day-to-day basis in selling a business. So please share this episode with some entrepreneurs you know. And as always, we hope that this episode has given you some serenity now. Thank you.
We hope you enjoyed this episode and picked up some good tips and best practices that would benefit your entrepreneurial journey. Remember, none of the content in this podcast should be relied upon as standard legal or business advice. Always consult a professional for your specific business. You may know someone who could benefit from this podcast. Please share it with your business community, and perhaps it can give an entrepreneur you know some serenity now.